Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I received a question from a client this week, and I made a few assumptions here, but I'm assuming that he took something as fact because he saw it in a textbook or something. And I want to point out that the map is not necessarily the territory, and not all textbook writers actually trade. So hopefully this will make sense in just a minute. It's not my way or the highway, but I think that what I'm going to show you here can certainly be useful. I want to continue my series on thinking like a trader, and I've been thinking recently that I'm never going to get done with this because there's so many things that I want to cover, and it overlaps with so many other subjects. So at some point, I realize I'm going to have to end this, and I think I have a pretty good ending for it, which could actually be the beginning for some other things. And that'll make sense if you just stick with it, stick with today's presentation. I want to do a little bit if I could do it, so can you, and that'll make sense as we get to it. I want to show you an open setup and then the open portfolio. And then housekeeping, I do take requests. As I often say, it makes my job a lot easier. Tell me what you want me to talk about, and I'll talk about it. And if it doesn't fit within this venue, which is a limited time slot, I could certainly cover it in my Thursday shows, Dave Landry's Week in Charts, which are a little bit more open-ended. If you want some more information on me, and if you want my books for free in PDF format and limited access to the members area and a plethora of other stuff to keep you busy for a long time, go to davelandry.com/StockCharts, and also I'll give you the slides from this presentation and all the other presentations too. If you need to reach me, davelandry.com/contact. Okay, let's talk about the mystery chart. In fact, this week we don't have a new mystery chart. We have a not a mystery chart and a little bit about the methodology and action. So GHVI is not a mystery chart because I did talk about it right, I think, as it was triggering or right before it triggered in Dave Keller's The Final Bell, going back about a month or so. And it was in a downtrend, and then it began to turn back up, and it formed a pattern I call a bow tie. And you can go in and watch prior shows for a lot more on that, or you can get the pattern off my website or from the books. But anyway, IPOs sometimes come public and they get a little ahead of themselves, like it did back here. They begin to die out for a while, and then they turn around and they go right back to their old highs. So it's a pattern I call a fly, a die, and then a fly. And you look to get long on that fly portion when you have something like a bow tie or some other transitional pattern. So the buy was right here. Stop was down here. It moved a little bit in our favor, so we bumped that stop up a little. And one thing that's been interesting that I've been talking about lately is how this trade so far hasn't stopped out, but it's been on the both sides of profitability. Now, based on the model account of $100,000, which I'll show you that portfolio in just one second, at one point we were up as much as 1763 on this one. Now, full disclosure, I had more shares in two of my accounts than the model shows, so I ended up flipping out some shares on this. So I did take some partial profits. That just was mostly, I suppose, luck because I had the profit target wrong. So I'm out of half of this position, but I do still have an open position here. And you can see that it varied from up quite a bit to down quite a bit. So it's been pretty volatile. And so far, we officially have not hit that initial profit target. So what do? Well, nothing. Now, the reason I keep bringing this up each week is I want to show you how longer term the thing to do is follow the plan. Now, in this trade, it could end up being a loss, but longer term, I can assure you the best thing you could do is follow the plan. And I'm going to beat the dead horse on that in just one second. Now, here's a question that I received a few days ago. What led you to conclude that trend lines are not useful for placing stops? Now, I just exchanged an email or two with this gentleman, and we're supposed to talk later this week, so maybe I'll ask him to flesh it out then. My assumption is he's taking trend line stops as being a way to trade the markets. And the reason I don't use those is because they'll stop you out prematurely. So here's the open portfolio, and you can see we have some pretty decent gains in here. One of them obviously up over 600%, another one up about 75%, 142%, and 50-something%, which is much better than a poke in the eye. Now, this is a 100K hypothetical account. I do actually take these trades, and I often take them in more than one account. And you're looking at this like, wow, Dave, you're up 48%. Well, not exactly, because there are some losers that have been taken that have stopped out. And there's some winners too. But yeah, the open portfolio is looking pretty good. Knock on wood. So here's ASO. We got in this stock. This is Academy way back last November. And if you were to draw a trend line beneath the lows, you could see that you would have gotten stopped out at a scratch or possibly a small loss. And then the stock subsequently took off to rally about 150% based on the close a few minutes ago. Now, if we take a look at APG, you can see that the buy was way back here, way back last July. So we're almost 1 year into this trade. And you would have gotten stopped out on a trend line right about there, right around $14 or so a share. And now it's at $21.39 based on the snapshot that I grabbed. And you can see that's about a 55% move. And that's much better than a poke in the eye. ARLP, another one of the stocks that we're still long. If you put your trend line in here, you would likely have gotten stopped out right around there, which is not a bad trade. But if you would have stuck with it, you could see that it's up another 33%. And that's not setting the world on fire, but that's much better than a poke in the eye. The big winner is CPE, which triggered last November. And if you draw a trend line, you'll see that you would have stopped out right about here, about, let's say, $14 and change. And if you would have drawn a little bit more aggressive trend line based on the accelerated trend higher, you would have stopped out roughly around the same area, but about a month and a half sooner. Now, since that stop, which is roughly around the same area, the stock has rallied 304%. Now, on the short side, we triggered into DHI back in early June. And so far, it really hasn't done a whole lot. But you would have stopped out of that one for probably a scratch or a tiny profit. And the question mark is, will the trailing stop being used on a somewhat liberal basis pay off much better than the trend line stop? And the results remain to be seen. But as you can see with many of those so far, knock on wood, they've done incredibly well. Now, this is not to say that every time you stick with a position as opposed to using something like a trend line stop, they'll turn profitable. But longer term, if you want to make any money, you're going to have to stick with positions until stopped out. Not throw caution to the wind, but follow your original plan, which includes a stop that you loosen over time. Go and watch the money management shows. And if you have a lot of time, go through the money management module on my website. That's behind the firewall, and you have to pay for that. But I think it's worth your while. Anyway, the point I'm trying to make with this is that things that sound good or are logical often don't work in real markets with real money. And I think a lot of times, and I don't want to throw anybody under the bus, but a lot of times people who write about markets wouldn't know a trade if it hit them in the butt. When you're down here in the trenches, life is a whole lot more different. Now, I'm sure if you're just writing about trading and not actually trading and using your real trades as examples, you could probably find an example where a trend line stop would have worked out really well. But the bottom line is markets take time to digest their gains. And the real money is in longer term trends. So you have to ride out those consolidation periods or correction periods, whatever you want to call them. Again, not throw caution to the wind, but allow that stop to gradually loosen over time to ride out these, again, consolidations and corrections. Now let's shift gears and get back to thinking like a trader. A trader thinks in terms of process. Profits are a byproduct. And I've talked about this slide quite a bit. In fact, I've done complete presentations just on this slide, so we'll kind of rush through it today. But the bottom line is you have to decide whether you have a must-take trade or a miss-take trade. Now, going into the trades, you don't always know, but once you do a post-mortem, you should be able to determine whether or not the trade was a must-take trade or a miss-take trade. Now, every presentation I do, I always say, Dave, don't quote Ed Seykota, and by the end of the presentation, at some point, I've quoted Ed Seykota. The must-take trade is intuition, and the miss-take trade is intuition. And the way you get better is you look at the trade when you're done, and you have to make the decision on whether or not the trade should have been taken. I think the true enlightenment comes when you have a negative outcome from a must-take trade through following the exact process, and you feel okay about it, and you shout next, and you go back and continue to take those must-take trades. The negative thing that can happen, as I beat the dead horse on quite a bit, is that the market could often be a bad teacher. And you could take the mistake trade, and after you look at it, if you made money on it, and if you say, you know what, I need to thank the market gods because this was a stupid trade to take, and I'm not going to take these mistake trades anymore, then I think you've reached the true enlightenment. But if you feel good about that bad trade, the trade that should not have been taken, even though you made money, then you're in a lot of trouble. Now, if you lose money on that and you say stupid and you realize that you shouldn't have taken it in the first place, learn something from that and don't do it again. So it's a great experience, even though it's a painful experience, as long as you learn something from that. Stupid, I think I've said this last week, but long story endless, my wife would come in and tell me stories about her boss each weekend. She'd come in on Monday morning and say, oh, this is what the boys did. She'd go through a big list of what the boys did, crazy stuff, ER stories or whatever. And at the end of it, she would say, stupid. So it's kind of stuck within our family. We use that word all the time. Anyway, but if you're feeling that stupid for that mistake trade, then again, that's one of those true enlightenment type of things. If you're feeling unlucky, then you could easily end up in that negative feedback cycle. Now, what I'm hinting at there is what Annie Duke calls resulting. And resulting is looking at the end result and making a determination that the trade was a good trade or a bad trade. Bad trades sometimes turn out well, and good trades sometimes turn out bad. And our job as traders is to separate the wheat from the chaff when it comes to the good trades going in to the bad trades going into the trade. Now, getting back to the process, it's very important that you follow the process. And I'm not sure how to say Mr. Everett's name, Duicknick. But Mr. Duicknick says, a bad plan that is well executed will yield much better results than a good plan that is poorly executed. Now, eventually your plan is going to have to improve, and we'll touch upon that a little bit in a few minutes. But the bottom line is, if you could follow a bad plan, you have what it takes to become a trader. You just have to get a better plan. And you might need a little better stock picking too, but we'll get to that in just one second. I vacillate from these holy grail hunts, trying to figure things out and try to find some sort of secret to trading, to the fact that there really is no secret to trading. There's just some very simple things. And if you do those simple things, you're going to be successful. And I think Michael Jordan said it the best, paraphrasing him. He said that there would be a lot more professional basketball players if they just stuck to the basics. And if you think about it in the markets, all you have to do, I know, easier said than done, but all you have to do is capture a price trend. Nothing more, nothing less. And you will be incredibly successful if you can do that. Rinse and repeat, of course, using a little money management and following your plan to get you through the process. So the secret to trading is pick the best setups in the best markets. Make a plan. And follow the plan. And then, of course, rinse and repeat. So you might be thinking, well, that's fine and dandy, but what if I'm not profitable? Well, provided that you're following a plan, you have everything it takes to become a profitable trader. You just have to pick better trades and better markets. Well, Dave, how do I do that? That sounds a lot easier said than done. Well, there's different things you can do. Some are going to cost you a little money, and no matter what, it's going to cost you a little experience. But I actually have a stock selection course. It's very expensive. And if you don't want to outlay that money, there are much cheaper ways you can do this, even for free. Number one, look at a lot of charts. And if you see a big price move in the charts, ask yourself, should I have captured that move, or could I have captured that move? And if your answer is yes, then you're training your mind to see that pattern again. Empirical research, that's a fancy way of saying look at a lot of charts. The other thing you can do, completely free, is to look at the archives for my trading service. Not that I'm the grand poobah, but I've been doing this for a while, and I know what to look for in stock setups, and that's completely free. Another free way of doing this would be come to the weekend charts and bring me your stock picks. The great thing about picking better stocks is a lot of it can be objectified. I don't want to say it's mechanized because I'm not a mechanical trader. I don't believe in mechanical trading. I spent many years researching mechanical systems and would wake up early and program. Now I just wake up early and look at charts, lots and lots of charts. But one way to get better is, again, look at the service archives and see what I was picking, and look at my Landry list that I publish every day and see what I was picking. And the archives are completely free. The live service obviously does have a cost. Now, look at some of the older weekend charts presentations that I've done, because in those I had a bigger audience, and the audience was much more broad, and we had a lot more amateurs in there. I was able to pick apart their stocks a little bit more than now, where it tends to, most of my weekend charts attendees are straight from my Facebook group, and these guys know how to trade, and so we might agree to disagree on setups, and you'll probably learn a little bit more from looking at what not to trade by looking at the older weekend charts presentations. Now, speaking of the Facebook group, that's the other thing you can do, relatively cheap. Facebook group is free, but you have to be a gold member of DaveLandry.com. And that's just to get everybody up to speed, make sure we're all on the same page. You could bring up trades there, and we'll take a look at them, both me and the other traders, and see what we think, and maybe we can help you with those trades, or maybe help you find something a little bit better. But a lot of it is pretty simple, like don't trade a stock that looks like an electrocardiogram. Don't trade a stock that has a whole bunch of overhead supply. Don't trade a stock that's too thin. So a lot of it can be objectified, but there is a bit of an art to it too. And that art, believe it or not, can be learned. And it can be learned through experience. Now, as a trader, you also need to think, as I alluded to earlier, Am I resulting? And resulting is a very dangerous thing. Resulting, again, comes from Annie Duke. And she wrote a really good book called Thinking in Bets. I have a new one here called How to Decide, which I haven't really gotten into just yet, but I'm sure there's something valuable because you always get something good out of Annie Duke. Anyway, Thinking in Bets, not necessarily a book on trading per se, but it's going to help you a lot in the way you think about trading. And another secret to trading is learn to separate luck from skill. And that's not an easy task unless, of course, you're willing to do some brutally honest introspection and, again, as I said earlier, have a bad outcome but accept that you did the right thing in spite of the bad outcome. So be leery of resulting. A trader thinks in terms of what he could have done better versus what he did right. Friday was one of my best trading days in a long time as far as the intraday trading. Now, I preach against day trading, but I do some intraday trading, meaning that I get into positions and I try to hold them all day long via trailing stops and limit orders for profit taking. Things such as opening gap reversals, or as I call them, ogres, Russian dolls, which would be stocks that come off my Landry list. ATOS would be an example of one of those today that worked out nicely. Anyway, on Friday, even though I had an incredible day, a day that if I could string together about a year of those days, you might never ever see my fat arse again, right? I should have been excited, but I wasn't because I had some losing trades. Now, losses are inevitable, but I'm thinking on at least one of those, I could have avoided that loss. Maybe I got a little too excited with myself because I was having a good day. And then the other thing that happened is in doing my nightly analysis, I saw a stock that took off without me that I had recently on my radar. So here I am kind of bummed out, but I had one of my best days of the year. Now, I had an okay day on Monday, and I actually felt pretty good about that. Even though I made 3 or 4 or 5 times as amount of money last Friday, I felt good about Monday's trading because I did the right thing. Even though one of the trades resulted in a loss, it is what it is. Seeing the same trade again, I would have taken that trade. Even though, of course, in hindsight, through resulting, we know it ended at a loss. Charlie Kirk was kind enough to invite me down to St. Lucia to be the guest of honor at his Traders Retreat. And I know I talk about this often, kind of last week at band camp, but it's something that I'm very proud of, and I really enjoy being with a bunch of traders. And someday, I hope to do that with my clients, even if we do it on a much smaller scale. In fact, one of you guys offered up your place in Hilton Head, and we might take you up on that someday. But it was great to get together a lot of traders, and it was just a wonderful experience, wonderful life experience. Anyway, long story endless, one of the traders said, you ever notice at the bar, the novice trader is bragging about how great he did, and the professional trader is kind of hemming and hawing, even if he made money, about how he could have done things so much better. Well, Annie Duke writes about Phil Ivey and Phil Hellmuth in her book, Thinking in Bets. And Phil Ivey, when he's at the bar talking about his poker, you would never know that he just won, in one case, literally $500,000 in a tournament, because he's talking about how he could have played his hands so much better, or this hand he really screwed up on, and so on and so forth. Now, Phil Hellmuth is the polar opposite of Phil Ivey. Phil Hellmuth once said, if it wasn't for luck, I would win every hand. Well, Phil Hellmuth is a good poker player, but I'd be willing to bet that he'd be a much better poker player if he thought more like Phil Ivey. And I think that Phil Ivey could be a fantastic trader. So a trader thinks in terms of the process, a trader thinks in terms of what he did right, and a trader thinks in terms of doing the right thing. Now, as I said at the beginning of this presentation, this series could go on forever because it dovetails into so many other aspects of trading. But the bottom line is your attitude is far more important than your aptitude when it comes to trading. And whenever I do a presentation, and especially if I present problems during the presentation, I want to also present solutions. And hopefully I've done that today. But the bottom line is there's only one thing you need to ask yourself when it comes to thinking like a trader. And that is, am I thinking like a trader? And this has been a bit of an epiphany for me. And trust me, I don't always think like a trader. This morning I came in, I saw the futures were getting kind of creamed, and all of a sudden they came roaring back. I jumped on the long side. This is pre-market. And then they began to implode. I got stopped out. I jumped on the short side, and then they took off, and I got stopped out again. And I realized that I'm not thinking like a trader. So this has been a bit of a curse for me since I thought about this. But in many cases, just this morning notwithstanding, I realize that I need to just ask myself, am I thinking like a trader? One thing that I've been guilty of and I'm working on is that sometimes I trade not to lose as opposed to trading to win. And the two things are diametrically opposed. Just because you could get into a position and think, okay, well, I could use a really tight stop on this thing. If I get stopped out, who cares? More than likely, you're going to get stopped out, and you shouldn't take that trade. Even if it's a little bit of money, you shouldn't do that. And I can't tell you how many times I've gone into a trade trading not to lose, okay, and say, well, I'm going to use a really, really tight stop, and then before you know it, I justify why I should give it a little bit more room, when the bottom line was I was just supposed to use a tight stop, and if I get stopped out, I get stopped out. And that sort of compounds itself into additional errors. So the bottom line is, am I thinking like a trader? Am I picking the best and leaving the rest? I know it's cliche. Am I planning my trade and trading my plan? And along the lines of asking questions, I think that in upcoming shows, I'm going to focus on the questions that you need to ask. And believe me, if you ask the right questions, you're going to get answered. I think it was Kettering that once said, a problem well stated is a problem half solved. And I think asking questions is going to get you answers, and that's going to be the topic of some upcoming shows. Well, hopefully I've helped you guys and girls to think like a trader, and from a selfish standpoint, this has gotten me really thinking, am I thinking like a trader? Because I don't always think like a trader. If you need some additional information or would like the slides of this presentation, all the other presentations, again, davelandry.com/StockCharts. If you need to reach me, davelandry.com/contact. I want to thank you guys and girls for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.